Good evening, guys. Thanks for your patience. Nightly strategy podcast for September 5th, 2022. Happy birthday to me. 65. Still working. Labor Day. There's one chart uploaded in the room. So I'm going to give Art some feedback on that. Then what I thought I'd do is I want to go through the daily report page by page and kind of address what each section is about, because it is a collection of tables and symbols and systems from a bunch of different strategies and different time frames that we've accumulated over time. And I believe the best way to use that report is not to master everything that's on it, but to know what time frame you're looking at, and therefore which pieces of the report are useful to you. And that way you're getting the data that you need to make your decisions and not trying to always look at every single thing. So with that in mind, let me share the screen here real quick. All right, so the only trade we have for today, regular market was closed, is from Forex. This is Arch in the Aussie dollar, the 5-minute. And what he's got here was a PSAR violation. So here's the PSAR flip. And then it broke down through here. So he gets short here. It immediately reverses. He takes the 0.7 loss. It reverses again. So he takes it again. Gets paid for 0.3. Has an SSC now. Takes the PSAR and the PSAR flip reversal here. Gets paid. I might have been a little more aggressive on this one because the RL10 did not get as low as it did the last time. And that's a subtlety, but it didn't get as low as it was going to go. And so that's really not a double bottom. That's really a kata 2. So I might try to take a 1-2 exit. It's a fractional difference anyway, but it's the idea that there's evidence to support an earlier exit here. Although the PSAR is fine, what that would allow you to do is get long here at the PSAR instead of here. And then that would save you this move. You would get that as a gain, which is about 0.4. And this would be about 0.1. So there's as much as a 0.5 improvement at that location. Similarly, when I look at this one, I see a 1, 2, 3 exit right here instead of here. So is that a difference that makes a difference? No. But yes, only that much. I think I would be a little more aggressive in there, particularly since the rest of the market's not open and this channel is narrowing. And I think I want to be a little more aggressive about locking in some gains in those positions there. Still in all, he comes in with a 0.7. I think with those little improvements, he might be able to capture 0.3 of those 0.5. So that could have bumped this up to a 1.0, which is a 50% improvement over 0.7. So those little distinctions will add up over time. But good work to get what was reasonably available on the Aussie today. All right, so I want to go straight to the daily report. I'll do the weekend report at a later date. So strap in. So this is our standard daily report, and there's a lot of pages on it. I mean, there's 28 pages. it's a collection of research and system signals that provides a robust framework for developing daily trading plans that can support 3 different trading time frames: intraday, swing, and position trading. So intraday, again, we're thinking about less than 1 day. For swing, I'm thinking about overnight, because every swing trade starts with accepting an overnight risk. And then in our system, the mechanical signals are typically seeing 3 to 5 day moves. Like, you're not surprised if the move that you wanted to see happens within 3 to 5 days and then starts to peter out. So there may have been like 5-day down, then we frame that trade and it works. And then 3 to 5 days later, it gives you the move back near the 10-day high. And that's the move that you were hoping to see. And if it happens in 3 to 5 days and it gets back to what the previous fair value was, that's all that you were hoping to see. That was the anomaly that created the opportunity. And so it's important to know that all of our swing trades, the mechanical swing trades that I'm going to talk about, we expect to see something in 3 to 5 days. And if we just double that, it is rare for that to last as a swing trade beyond 10 days. So if it's gone through 10 days and has not achieved the recovery that we expected or hoped to see, then there's a good chance that that thing's not happening, that the anomaly that you thought was there is not really there. And so that's not happening. So when we talk about the intraday, again, it's less than 1 day. Swing trades begins with an overnight risk and then usually a 3 to 5 day move, but it could last as long as 10. But if it goes more than 2 weeks, which is 2 5-day trading weeks, then we're talking about position trading, in which there's a much longer term opportunity that is manifesting. So that could be something like a regression line fractal framework, where we have the RL270 is up here at some time over on a daily time frame. Daily charts gives you an RL270 up here. And then for whatever reason, the RL10, which had been up there, sells off sharply and then starts to reverse. Well, the difference between the RL10 and the RL270 is the difference between long-term buy and hold, what they think of as fair value, and the trader's price, which for some reason that we don't know or care has caused price to move down and then start to reverse. So when we're thinking about position trading, this move might have been, if we measured this in terms of average true range, this could be something like, in this case, 5 ATRs. It would be an incredible move for this to move back 5 ATRs in 3 to 5 days. It may take a lot longer to recover than it took to sell off. Why? Because the breakdown driven by fear usually happens faster in time. This might have happened in 3 to 5 days, the sell-off. But the recovery is like climbing up the stairs. That could take anywhere from 3 to 5 times longer. So that could be anywhere from 9 to 20 days. So it is normal behavior for these position trades to last longer. So when we're thinking about 3 time frames, intraday, swing trade, position trading, that's what we're talking about. At the extreme edge of the position trading, you're going to get into what we call the monthly rebalancing, blended monthly rebalancing, or the BMR, which is a once a month adjustment among the relative strength leaders. So that's monthly. asset allocation, and features rebalancing, and is based on relative strength, powerful relative strength. So that would be an extreme form of position trading where we're holding that position for longer than a week. Okay. Now, the next note, pages 3 through 16. So that's going to start off with the market health check and go all the way through the multi-time frame NDX. All of these that are in blue, these all have signals. These are all signals that are going to feed one of those three styles of trading: the intraday, the swing trading, or the position trading. The only one that's not is this one, page 11, which is just a restatement of the sniper concept, because that's our newest form. And so I wanted to have a summary of the concept to remind people what's going on in there. And so then pages 12, 13, and 14 really are looking at the sniper concept. And then all of these that are in blue really are giving us signals, and that's the primary locations for finding specific targets or trade frames for most of our active traders. Now, pages 17 through 28, these are additional pieces of market research that we do that add an extra layer of detail and complexity to the various timeframes. Some of them are intraday, some of them are swing, some of them are position. None of these are ever necessary for immediate tactical trade framing, but it is often a source of interesting insight and ongoing research, and it gives us the ability to craft individual trade narratives that are not immediately obvious from these that are in the blue. So these are, I think of these as general support, or deep and sometimes indirect ideas, an extra layer of nuance. A lot of times these are things that are still cooking for me, that I haven't figured out how to incorporate them directly perhaps into a system, but they're there as additional background, adds extra levels of detail for the market mosaic. So taken all together, these things are, my friend Robert Gardner used to call this the market mosaic. And his idea was this, that over time, you get a lot of very specific systems that give you direct action, but that the market is really such a complex area that really you start getting all of these separate little insights into certain pockets in the market of what's going on up and down. And what happens is these start connecting in deep and mysterious ways, to use his language. He was kind of a mystic, as well as a pro money manager for 45 years. And he said that you get a feel for what the market is doing in the macro sense. By piecing together all of these little pieces, you start seeing connections and interrelationships that are not immediately obvious with one or two indicators. And sometimes you need to piece together the larger picture of the market mosaic. And so when you hear us talk about the phrase market mosaic, that's what we're looking at. A lot of these have to do with aspects of the market itself, like 17 and 18. I'm going to look at those two charts. Those are really important to me as part of understanding what the broad market SPY is doing, because so many of the things that I trade are directly connected to SPY. This gives me extra insights into position swing trade turning points, changes in volatility, historical norms. How long has this trend been going on, and is it due for a slow change? So it keeps me alert to maybe some subtleties in market conditions that are not immediately obvious. The same with 19 and 20, Z-scores and volatility. So we'll get to those when we get to those. So far, so good. So the first chart that we've added in here is just the sniper trade of the day, because it is my contention that everybody would benefit from thinking like a sniper, in which you have a sniper headquarters back here in the base camp where everything is safe, and it is generating a list of targets. And this list of targets is a set of symbols that, because of location and volatility, are more likely to move sharply than other symbols. Or for a particular target, the condition that it's now in, location and volatility, makes it more prone than normal to make a surprisingly large move. So we've identified about 5 standard patterns of setup that combined location and volatility to put things on the sniper target list. And then those things that are on the sniper target list, once they start moving, there's about 4 standard patterns that we use to trade them. Like location and volatility that puts it on the target says, this thing is a runner. It's going to move. Now, how is it moving? Well, that's where the patterns are going to come in. Things like a Z3 pinch, a supported spring crossing, a Kata 2 continuation trade, a collapsing dragon. I'm going to make it 5 patterns, or a morning hook like a WMB3. Those are 5 standard patterns of actual price movement that tell us if these potential runners are actually running. So it's important to know what the 5 standard patterns are so that we can specialize. And then we need to know what the 5 standard price patterns are so that we can frame the trades and trade them in a standard work kind of a way. Check or hold. So the second page then is the sniper trade of the day. I just pick one of them that is representative of sniper trading to illustrate what is available every day in the market with no overnight risk for people that are prepared to trade in this manner. So this was one, it was 3 minutes on US Steel. This was a collapsing dragon that failed for -1. This was a Kata 2 pattern that was at 1R in hand, and then I scratched for no gain. This was a second Kata 2 pattern that paid 1R. This was a supported fall crossing PSAR flip, which paid 1, 2, 3, 4R. And then this was a Kata 2 that paid 1R. So that was about a 6R day on Friday in US Steel, which was on the sniper target list. Why? Because of location and volatility, put it in a compound critical state, meaning there were multiple reasons why that thing should move large intraday. And it actually did once, then twice, for a 6R traded in a standard with standard patterns. So that gets us now into page 3, 4, and 5 of the daily report. And in this one, we take a look, we're going to look at 3 market conditions. And we're looking at market 150, market 30, and market 10. Because in the sniper mentality, the sniper mindset, looking back 150 days, and this is today, so this is a 150-day look back, which is this purple box. That represents position traders. And in terms of location, we set that equal to 100, the highest high of the last 150 days, which is here. We set that equal to 100, and the lowest low of the last 150 days, which is here, set that equal to 0. And then we divide this into 100 equal increments, and that's called indexing. And so now when we look at where the price is, we can see that's at about the 30-yard line, or 0.3 on the scale of 0 to 1 or 0 to 100. That would be 30. So that's not in a critical state yet. What we're looking for is the top 10 and the bottom 10 for it to be in a critical state on market 150. Now, this gives us context for the longer term swing and position trades. And you'll notice that we have 5 30-day boxes marked off. So there's 1, 2, 3, 4, and 5. So each one of those is 30 days worth of price data. And then we've smoothed out the price with the blue 10-period moving regression line. And then we've put the PSAR to give us the direction and magnitude of the trend. And we've timed that so that when the PSAR flips, we get interesting and significant turning points on these longer term time frames. So then when we look at the closest 30, we break that into 3 10-day periods. And then the 10-day period, we break into a 10 and a 5 and the 1. So we're looking at the 1, 5, and 10 for close-in trading, because that supports intraday and swing. So intraday and swing are really concerned with 1, 5, 10, and 30-day lookbacks. Position trading is concerned with the all the way back to 150. Now, there was an important moment when this was at a 150-day low. That was also the 10-day low and the 30-day low. And we featured a lot of Godzilla trades when all of those 3 look-back periods were all hitting rock bottom around 0. And then we got supported spring crossings that moved and kept moving for a very nice move from about 360 up to about 435 in the S&P, which is a move of plus $75 on 360. That's a 20% move. And we were able to manage that with a series of intraday and swing trades that grew to become position trades. And so in that sense, we had intraday trades that became swing trades, which became position trades. And we call that advanced hybrid trading, because we're actually using systems and signals from each of those time frames to shape our daily trading plan. So this market look back begins with the market 150, which is this one, because it gives us the longest look back period and supports our traders that are using primarily position and maybe some swing trading, and maybe they don't want to be intraday day traders. Well, you can make a living on position trading and swing trading. And in our view, 150-day look back gives you plenty of context for location and relative volatility to be able to do that. It allows you to interpret the quality of the signals that you're getting and the ability to frame them for normal moves back to support and resistance, given about a 6-month look back time frame. So the first of the 3 pages we look at then is the market 150. After we've looked at that, we're going to zoom forward and look at market 30. Check or hold on market 150. Let me add just a few other comments. This is where I like to put these purple lines, because these represent important support and resistance levels. Like this was a PSAR test. This was an important support level here. This was an important support level in the RL10. And this was an important turning point a couple, 3 times. So this price level here, this between 420 and 410, this turns out to be very significant as support because it bounced. And when support breaks, it collapses. When support becomes resistance and collapses, you get these big moves out of support and resistance. When this one failed to bounce, it collapsed. So on the 150 is where I'm making some of these kinds of measurements about important price levels that were historically significant. Like when this one broke, this was the beginning of this long-term painful move down to here. And when each of these resistance levels broke, you started getting large moves to the upside. So when we talk about location and volatility, we're also talking about support and resistance. So when we take a look from market 150 down to market 30 and market 10, where we're looking back 30 days and 10 days, we're going to carry forward these very important price levels, because even though we may be concentrating on 30-day look back, there's all of these other guys that know where these support and resistance levels are. And when it hits inside our time frame, these guys may come in and act. And if we don't know where they're going to be triggered, we might be surprised by sudden moves out of support and resistance. So we get paid to look at a multiple time frame look back in order to come up with these compound critical states. So that's what I want to say about market 150. Check or hold. The next one I'm going to look at is market 30. And this is the same information, but now it's easier to see some of these crucial support levels. And now price becomes a little more important. And you can see how important the PSAR is, because when the PSAR flips, you go from a period of strong upward move to a period of strong downward move. So you want to know where those PSAR flips are occurring. We can now see the dragon, which is the RL10, the moving RL10, and the baby dragon, which is a 3-period moving average on the RL10. That becomes important. This faint but important 10-period Bollinger Band, the dragon, where it makes these turning points, become important support and resistance levels, as do the peak of the RL10. So those two price levels are going to be important later on. So the market 30 allows us to see a little more deeply into what's going on in the swing trade and intraday considerations. Anytime there's a PSAR flip, it's very important. Anytime there is support and resistance marked off by the RL10, it's important. Support and resistance measured by the dragon is important. Noticing the Williams percent R10 for overbought and oversold, and the MACD histogram for the seasonality is important. So now what we have is an oversold with an uptick and an opportunity here for the market to find support and recover back to resistance, or if it breaks down from here, look out below. So this is a really important price level right here around 390, as we covered over the weekend. So that's the market 30. That allows us to get a refined look. The next one we look at is the market 10. And on this one, we're using a 10-day look back period to here. This is the 10-day, and this is the 5-day box right here. This is the 10-day box with the high here. And then they both have a low, right? That's both the 5-day and the 10-day low. Now what we're doing is, instead of looking at daily bars, we're looking at 30-minute bars, of which there are 17 per day. And that gives us the ability to break the 5-day into 5 chunks. And now we can see what's happened over the last 5 days and 10 days, and see we've pulled in the support and resistance levels from the higher time frames. So now we get the sense that if this breaks out of the last 30-minute bar, which closed near the 10 and 5-day low, there's no resistance over here at all. And so this failure could immediately go to 382 without any trouble. Like there's no support in here that's going to stop it from failing immediately. Conversely, if this breaks out of that critical state range, just like it did here, this could end up being a nice move up to 403, which is an $11 move against a $2 risk. That's a 5-to-1 reward to risk ratio here, and about 4-to-1 there. So this is at a critical state on the 30-minute chart, which is why that we want to be especially prepared to trade tomorrow morning. So taken together, these are the 3 market conditions that we're looking at. Where we're looking at the market health checks, the 150, the 30, and then the 10-day, which features the 30-minute. Okay, then that's going to lead us to dashboard number 1. This is as far as we're going to go tonight. There's a lot going on in dashboard 1, so I want to keep it fresh. The very first thing that I look at in dashboard 1 is our market classification system. We have a separate information paper on it, and in that paper we describe how we measure 2 dimensions. It's going to be bullish, sideways, or bearish, and it's going to be volatile, normal, or quiet based on different criteria. And what that does is set up 9 different market condition states. Like we could have bullish volatile, bullish normal, bullish quiet, sideways volatile, bearish volatile, and so on. Sideways normal, sideways quiet, bearish normal, and bearish quiet. Now it turns out, based on statistics, we go back 10 years, and we classify each one of those days. That's about 2,500 days. And each one of those days is when the market closes, puts the market in one of these postures. So there's 9 buckets for each one of those market conditions. Check or hold. So what we do is we go back and we take a look at all of the bullish volatile. And then we say, When the market closed in bullish volatile conditions, what was tomorrow's 1-day percent return? What did it do the next day when today it closed in bullish volatile conditions? So all we're looking at is a 1-day step forward. What is the tendency? Well, it turns out that there are 4 market conditions where tomorrow on average is up. And that's these. It turns out that any bull plus sideways quiet on average tomorrow is a positive day. So that means bulls tend to persist. And it doesn't matter what the what the other long-term stuff is going on. All we need to know is that tomorrow on average is up when it is any bull plus sideways quiet. Now it turns out that any bear on average is negative tomorrow. So on average, any bearish volatile, bearish normal, bearish quiet has been negative the next day. And then the other two sideways volatile and sideways normal, on average, are flat. So where this really matters is if you are a swing trader or a position trader, you want to know what the market condition is today to tell you if there's an advantage statistically in holding it overnight for one more day to see what you can get. It turns out that if you're long, there's no reason to hold it overnight because tomorrow on average is down anyway. So if you're in the money today, you might want to consider just cashing your winner. On the other hand, if you have a good intraday trade and the market is any bull, you might be willing to keep 20% of the intraday trade on the hopes that tomorrow may continue that trend upward because it's generally bullish and today was a good day. That would be justified. So this market classification strategy then is the first place that I look at to determine SPY's market condition, because SPY is worth 50% of the things that I trade. The market itself contributes about 50% of the returns of ETFs and large caps that are strongly correlated. The sector that things are in contributes about 25%, and the individual target itself about 25%. So if you can get the market right, half the battle is won if you are trading things that are strongly correlated to the market like I do. I'm looking for efficiency. So the market classification system then allows me to establish the market mosaic or the market conditions with respect to location and volatility. The next thing that I look at is the multi-time frame NDX. Let me go back and just finish market classification because somebody's going to ask me this question. The first thing I do is determine if it's bull, sideways, or bear based on price compared to the 200-day moving average. One of the things that we know is that the When price is below the 200-day moving average, that can be considered bearish, that tomorrow on average is down. Price is weaker when it's below the 200, and price is bullish when it's above the 200. The extra piece of refinement that we do is that we put a 2% band around the 200-day moving average, and we call that sideways. And the reason for that is we have discovered that when price is that close to the 200-day moving average, within 2%, it tends to be a little choppier. It's not until price moves out of there that it really starts becoming bullish or starts becoming bearish. This period of extra chop in and around the 200-day moving average means that tomorrow on average is neutral, unless it's very, very quiet. If it's very quiet, then there is a slight advantage to the upside. So don't be confused by the word sideways. We don't mean that price is moving technically sideways, although it might be. What it means is that it's in a location compared to the 200-day moving average where tomorrow is more likely to be flat or non-directional until such time as it climbs more than 2% away from the 200-day moving average. And that is a true statement, even if the 200-day moving average slope is down or sideways or up. We always put that 2% band around it to determine, are we in bullish, sideways, or bearish? Check or hold. The next thing that we look at is the volatility. Volatile, normal, or quiet. And what we use on that one is the ATR percentage. 14 as a measure of volatility. So we go back the last 100 days and we compute the ATR percentage of day minus 100, day minus 99, day minus 98, etc. So we take 100 days of volatility and we rank that. We rank the volatility on the basis of what was the most volatile day out of those last 100, and what was the minimum volatility, and what was the average of those, and then what is the plus or minus one standard deviation. So on the basis of that, we take a look at today's volatility. So the 0 day of volatility, what was the ATR percentage today? And then we compare it against the last 100 days. And then we say, if that volatility was more than one standard deviation above average, then we call it a volatile day. And if that volatility was within plus or minus one standard deviation of normal, of average, we're going to describe that as normal volatility. And if that volatility was more than one standard deviation less than the 100-day average, meaning it's very quiet, we're going to call that a quiet volatility. So that's how you get these three categories. Is it a volatile, normal, or quiet day? Now, what we learned was that quiet is always good. Volatility is a sleigh ride. It is a rocket ride. This could be great or it could be bad, but it's going to be a big move, and then normal is just normal. But quiet is always good. And that's why when you look at our 9 categories, that any any bull plus sideways quiet are always good or good enough. So we measured the results of the next day based strictly on bullish, sideways, and bear, and it was always better to be in bull, and sideways were mostly flat and bearish was negative. And it was always better to have quiet and then normal and then volatile. But we also tested all 9 of those categories separately to see if it was still true that bearish volatile or bullish volatile was good, and it was. And that's how we came up with this 9-state category of market classification. Because this is a classification that suits the way that we trade. Most of our trades are intraday or 3 to 5 days, and this is a market classification that is sensitive enough to give us an advantage when holding trades between 1 and 5 days. Check or hold. Whatever your market classification strategy is, it should be geared to giving you useful information in the time frames that you are trading. That's what I want to say about that. The next thing that I'll talk about is and this is as far as we're going to go today. I want to talk about the multi-time frame NDX. So now we're looking at trade location, and what we're looking at is look back periods of 2 days, 10 days, 30 days, 90 days, and 270 days. This is the same idea that you saw with the sniper. The sniper looks at a 150, a 30, and a 10, because that's what the sniper does. But what this gave us was a little bit of a longer time frame. It was also correlated to the regression lines that we use, because we use the 270, the 90, the 30, and the 10, and we wanted to find out what the index value was on a scale of 0 to 100 for those look-back periods in the same way that we use the regression lines. We have since added the 2-day because we've discovered that a 2-day decisive move to the bottom or the top of that index period is often an indicator of a sharp reversal or a possible breakout. So a 2-day extreme reading has also gotten our attention for short-term trading. Now, what you can see here is that we've got a very simple heuristic that says, if this is better than 80, then it's going to be overbought and in the green. If it's between 50 and 80, it'll be neutral plus. Between 50 and 20, it'll be yellow. And then if it's if it's less than 20, it will be oversold. So that gives us a very simple rubric to quickly integrate at a glance the trade locations on 5 look-back periods. Check or hold. Good. All right. Now, that's as far as I want to go for today. What I will do the rest of this week is continue to add to this review of the daily report and all the little pieces. But I wanted to go deeper into detail so that you could begin to put together a deeper understanding of the report and how to use it. All right, so that's everything I want to cover for tonight. It's getting late. What are the numbers in the items? You mean like it says 26 and 43? Yeah, so if we were to scale this on a scale of 0 to 100, with 100 equal increments, that's what you would get. It's like, you could think of it as a thermometer. Like on the 270-day look back, it's at the 26% level. So right now, if we went back and looked at 270, the highest high of the last 270 days and lowest low, today's price would be 26% of the way up the stack. On the 90-day, it's at 43. On the 30, the 10, and the 2, it's horrible. So this recent sell-off of the last 30 days is much more painful than the longer term. But if we went back about 10 days, we'd have seen that all of these were up here in the green and everything was beautiful. And the two longer term ones were above the 50-yard line. And that's where the market condition was just 10 days ago. And so what this thing lets us do is to be sensitive to how quickly trade location can change in a short period of time. So, for example, if we went back and looked at the I'll just go back and look at the daily report. Now what you can see is I'll do this one. It's easier to see on the 30, market 30. All right, so if I go back just 10 days, so here's today. Oops. And this is this is 10 days ago. Imagine what it was like when this was today, and go back another 5 days when this was today, 15 days ago. The 10-day box would have looked something like this. 15 days ago, when price closed here, that was like at a 95 on the 10-day look back, because here was the 0, here was the 100, and this was like at the 95th percentile. So the 10-day, so if we looked at the 270, 90, 30, 10, and 2, this looks, on the 2-day, this looks like a 90 or a 95. On the 10-day, it was a 95. And on the 30-day look back, this was amazing. It was also up in the 90s. And so everything was wonderful. But when the RL10 peaked and crossed the baby dragon and entered the dragon and left the dragon and hit the PSAR, just 5 days later, this is what that 10-day look back looked like. That had moved from 90 down to about 50. So on the that little NDX, you could see that thing rolling over and becoming dangerous. And then when that broke below the 10-day low, that set off panic selling. So when you see things break below their 10-day low, this is kind of like the swing trader's time frame is the last 10 days. And as long as this thing is moving up and it's above the 50-yard line, that's good. But when that thing rolls over and starts to start looking down, man, that thing gets bad in a hurry. So when we set up the 10-day, we take a look at these little price levels, that between 0 and 20, when it is oversold, that's a critical state. That means it could either rebound sharply, buy on a dip. Like if it comes down here, that's a buy on a dip, or it's watch out below for a collapsing dragon. By the same token, when it is overbought, when it's above 80, this thing is over. This is also a critical state. This could be the signal for a breakout, or it could be a reversion to the mean, which could then go to overbought or oversold and then fail bigly. And then finally, when this thing is right around the 50, this thing is like a fence sitter. And this thing could either move to overbought or to oversold. So in our sniper mindset, let me zoom ahead here a little bit. When we're taking a look at the sniper mindset and we're considering just trade location, we're setting these things equal to between 100 and 0 on a 100-point scale for 3 look-back periods, 10-day, 30-day, and 150 days, which is also 30 weeks. 10 days, 30 days, 30 weeks. And then inside of each one of these look-back periods, we see when it closes in the upper 10, we think of that as a breakout zone, and it could continue to break out, or maybe it fails back to the midpoint. We think of the midpoint as a critical state because here, this thing could rebound to overbought, or it could fail to oversold. So this thing could leave here and go to here, or go up to here. And then finally, category C is if it's in the bottom 10, it's in the breakdown zone. And here it could either rebound from support or it could collapse. So in each one of these look back periods, there are 3 critical states: overbought, oversold, or a fence sitter. If it's stuck in this area in between, it's just moving. It's not in a critical state yet. Check or hold. So now we're looking at multiple look back periods. So we're going to perform this calculation on the 10-day and the 30-day and the 30-week or the 150-day. So when we're looking at trade location, we're taking a look at trade location on 3 different buckets. Why? Because each one of these buckets represents a different demographic of trader. Long-term buy and holders are concerned about the long-term look back because they are position traders. Swing traders are concerned with the 30-day look back because it shapes their view for the next 5 or 10 days. And then intraday traders are interested in the 10-day, 30-minute chart because that sets up some sharp one-day moves. Now, when we have a symbol that is in a critical state on all 3 of those time frames, we have magic. It is a compound critical state. And so when we're looking for a Godzilla, one of our 5 standard setups, he is in the bottom 10% on the long term and the midterm. And then we are willing to accept him at the extreme high or the extreme low on the 10-day, because Godzilla could break down and then shoot up short term and then continue or fail big. And we also want him to be volatile, because in the sniper, trade location is only one of the criteria for a compound critical state. The other criteria is volatility. And we want that to be either extremely volatile or extremely quiet, because from extremely quiet, you get surprise breakout moves. Surprise, it's breaking out. Yeah, but it used to be so quiet. Yeah, that's why it's a surprise. The other place that gets big moves if it's already volatile. Then the volatility could continue in the same direction, or it could reverse with big volatility. So the things that make sniper targets are compounded critical states in which location and volatility lead to the possibility of increased large moves. That is the essence of a compound critical state. And then we've identified these standard patterns to pick particular conditions in which they are prone to move. We love the Godzilla, and that was great about 50 days ago when there was a new 10-day, 30-day, and 150-day low. But lately, the fireworks have been great. And they've been great for two reasons. Sometimes they kept going up, and now lately, the last 15 days, they have been collapsing. And both of those moves are exceptionally large, and that's why we like fireworks and Godzilla the most. Check or hold? So that's as far as we're going to go today. So the multi-time frame NDX is similar to and reinforces the sniper trading, and the market classification is our broad view of the market's one-day possibilities based on statistics of the last 10 years of daily performance. Both of those give us a considerable edge in position trading, swing trading, and intraday trading. So we will continue this as we go, and we'll put all this into a short course for you as well. That's all I got for you. W, you all right?
All good, brother.
All right, man.
All good.
That's all good. Yeah.
Anybody interested in trading tomorrow at 10 to noon, let me know. Going to be on